So when discount rate is given, you have to look after the PV factor table. So that is your PV factor table. So at rupee 1, what will be the first year value? It is 0.909. The second year it will be 0.826, and the third year it will be 0.751. Project B similarly will calculate the expected net cash flow, that is 16,000. So how did you get? Hello everybody, I am your Divya ma'am, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. It's my honor and privilege to welcome you all for the session 2 on your unit 2 on your risk analysis chapter, that is risk analysis and capital budgeting. Risk analysis and capital budgeting, that is single period NPV calculation, that is expected net present value calculation, and your multiple period net present value calculation, and we'll discuss what is variance, standard deviation and the problems on that, and later we'll be discussing the problems on the coefficient of correlation. So before that, let us understand the terminology first. What is variance, what is standard deviation, and what is coefficient of variation. So moving forward, let us take a problem number 1. So in the last class, we have discussed about the probability technique. So under that, we have just calculated, assigned the probability, and we have just calculated the probabilities, and we have understood how to calculate the expected net cash flow. So in today's class, we'll be discussing how we'll calculate the expected net present value. So in that, we'll discuss which project is better, what is the risk that is associated with each project, which alternatives should be chosen. Moving forward, let us understand the questions carefully. Possible net cash flows of a project A and B at the end of first year. So only 1 year values are given, only 1 year's cash flows are given in the question. So their probabilities are given as below. So the probabilities also, they are given in the question itself. Discount rate is 10%. So as I have told you, to calculate the net present value, expected net present value, so when discount rate is given, you have to look after the PV factor table. So that is your PV factor table. So at rupee 1. So if you see that 1 year, what is the percentage? 10%. So that will be around 0.909. So for second year, third year, it goes on. So it will be in your textbook, that is your IM Pandey textbook, whatever the FM textbooks you have as per the syllabus you have been given. So in the syllabus overview class also, I have told you about the books for references. So in that books for references, your PV factor table is available. So for 10%, it is how much? 0.909. So discount rate for both the project, initial investment is how much? 10,000 rupees. From the following information, calculate the expected net present value. Expected net present value for each project, and tell me that state which project is preferable. What is the risk that is associated with each project? Which project, if we choose, the risk will be lesser. Which project, if risk is more? So by solving the problem, we'll discuss. So they have asked to calculate the expected net present value. So how to calculate the expected net present value? The expected net cash flow into probability minus initial cost or investment. If we do that, we'll calculate the expected net present value. So this is the occurrence, possible event of 1 year. So number of years is not given. So it is a single period project. So they have given project A and project B. 2 projects are there, but the number of years is only 1 year. But the possible events they have given in the question. So what is the first step we have to follow? We have to calculate the expected net cash flows. What is the first step that we have to follow? We have to calculate the expected net cash flows. Expected net cash flow. So how do you get this expected net cash flows? When you multiply the cash flows with your probability, and if you add the total of that, the summation of that, you will get your expected net cash flow. I repeat, how do you calculate the expected net cash flow? So your net cash flow into probability assigned in the question, and the total of that will be your expected net cash flow. So that is the first step. Second step, what you have to do, you have to deduct the initial investments, initial cost, then whatever the answer you get will be your expected net present value. So let us look into the problem and discuss that. Project A, 8,000 probability. Project B, 24,000 probability, 0.10. B project, that is your possible event is B, 10,000, probability is 0.20. Cash flow for project B, 20,000 into your probability 0.10. So the occurrence of an event or the possible event is given for 1 year period. So we need to calculate net present value. Moving forward, so this is your solution. Project A and project B, as I have told you, what is the first step to follow? The first step is to follow the expected net cash flow. What we have to find out? Expected net cash flow we have to find out. So how to find out expected net cash flow? Your net cash flow into probability. So if you do that, the expected value you get, the summation of expected value is expected net cash flow. I repeat the point. So how do you calculate the expected value? Expected value is equal to net cash flow into your probability. Multiply the probability with the cash flow, you get the value. So the summation of that is what? Expected net cash flow. Similarly for project B, cash flow, probability, expected value. So your cash flow 24,000, 20,000, 16,000, 12,000 and 8,000. The probability is assigned in the question. So we are taking up the same probability. So multiply these two, you will get your expected value. The summation of this is what? 16,000. That is your expected net cash flow. So as I have told you, so how to calculate the expected net present value? Expected net present value is equal to expected net cash flow minus your initial investment into your discount factor, that is your PV factor at rupee 1. So for 1 year, 10%, it is 0.909. So as I have told you, for next, the net present value for project A is, as I have told you, the discount factor rate 0.909 into your expected net cash flow minus your initial investment. So where is initial? This is initial investment or cost. If you take up that, you will get your net present value. So what is the net present value? 908 rupees. Moving forward, similarly we are doing for project B. So how to calculate the net present value? So your expected net cash flow minus initial investment into your discount factor value. So discount factor value we are taking 0.90 only because it is 1 year. Discount factor rate at 10%, it is 0.909. So we are taking that. So the value will be 4,544. So this is the value that we got. So this is how we calculate the net present value. Moving forward, let us calculate the net present value for multiple periods. So this is single period, only 1 year, number of occurrence, top 2 projects were given. So we'll take up the next problem, that is your multiple period. So when the multiple year, number of years is given, when your multiple period, how to calculate the net present value. Question, possibility for the net cash flow for 3 years of a project. A single project is given. So that is your project year 1, year 2 and year 3. So only one project and the number of years is given in the question. Cash flow 2,000, 4,000, 6,000 and 8,000. Probability for second year cash flows are 2,000, 4,000, 6,000 and 8,000. Probability is given in the question. For year 3 cash flows are given, probability is given. Calculate the expected net cash flow. First what you have to calculate? Expected net cash flows. First, you have to calculate the expected net cash flows. Also, calculate net present value of the project using expected cash flows using 10% discount rate. So, first they have asked to calculate what? They have asked to calculate the expected net cash flow. By using that, they have asked you to calculate the expected net present value when the discount rate is 10%. So, in the last case, there was only 1 year. The discount factor for 1 year 10%, it was 0.909. But here the number of years are different. For second year, the discount rate will be different. And for the third year, your discount rate or your PV factor will be different. So let's look into that. So year 1. So how do you calculate? The first step is what? The first step is to calculate your expected net cash flow. How do you calculate your expected net cash flow? Net cash flow into probability. You will get your expected value. The summation of the expected value, the total of all the years, it will be 6. The total of all the possible events will be 6,000 for year 1. For year 2, it will be 4,800, and for year 3, it will be 4,200. So, with the help of this, we will calculate the expected net present value. Moving forward, the present value of expected cash flow at 10%, as I have told you. So, this is the formula. Expected net cash flow of year 1, year 2 and year 3. So, this is discount factor. The K stands for what? Discount factor for 1 year, second year and third year. So, what will be the first year value? It is 0.909. The second year, it will be 0.826, and the third year, it will be 0.751. So, this is the value. So, first what you have to do it, take up your expected net cash flow into your discount factor rate or PV factor rate. So, 4,800 second year net cash flow into your PV factor at 10%, it will be how much? It will be 0.826 as per your PV table, 10% discount rate for year 2. And moving forward for the third year, the net cash flow is how much? Expected net cash flow is how much? 4,200, and discount factor rate at your PV table year 3. That is your 10% discount factor, PV factor, that is 0.751. That is the value. So, if you multiply the values, add it, the summation of that, you will get it how much? 12,573. So, 12,573 you have got. So, you have to calculate the expected net present value. So, as I have told you, you have to deduct from the initial cost or the initial investment. So, present value of cash flow minus initial investment. So, initial investment given in the question, that is 10,000. So, this 10,000 we are deducting here, and the value we get is how much? 2,573. So, that is your expected net present value. So, that's it. So, we have discussed the calculation of probability. How do you calculate the probability and calculate the expected net cash flow? By using the expected net cash flow, we have discussed how to calculate the expected net present value for the single period and for the multiple period. Moving forward, let us understand variance. So, in your probability techniques, so risk analysis techniques we have discussed. Under that, we have probability, that is statistical technique. So, we have discussed the probability. So, and that another technique in statistical analysis we have is variation, standard deviation and the coefficient of variation. So, let us discuss one by one. So, variance, it is symbolically represented as variation. So, variation is a measurement of degree of dispersion. Suppose you have an investment of 5 lakh rupees. So, what is an investment you have? 5 lakh rupees, but you have got the return of 3 lakh. So, what is the difference? The difference is called as variation. So, it is symbolically represented as this. Standard deviation symbolically represented as standard deviation this. Okay. So, degree of dispersion, variation is a measurement of difference between average of a given set of data. So, you understand the variations Variation measure the uncertainty of the value from its average. Thus, variation helps an organization to understand the level of risk. What level of risk you have, what degree of risk you have. So, with the help of variation, you will be able to understand in an easy way. So, as I have told you in the initial classes itself, so the standard measure to measure the risk it is used is variation and the standard deviation. So, that is what they are telling here. Moving forward, the large variation. So, if the variation shows you the large number, then there will be a large variability between the cash flows of the different years. So, the returns will be very different from one year to the other year. The expected return will be varying from one year to another year. So, this can happen in case where the project being undertaken is very innovative project and would require a certain time framework to market the product and enable to develop a customer base and generate the revenue. For newer products, we can expect the return as this. Moving forward, when you have a small variation in with respect to the returns what the company get, then the cash flow would be somewhat stable. It is stable. The cash flow is coming to an organization in a stable way. Throughout the life of a project, this is possible in case of project which already have been established in a particular market. When sales is high, the product is known to the customer, so the returns will be of the cash flow, obviously it will be expected. So, variation will be small. When the variation is large, it indicates what? The return is not stable, unstable return. So, small variance indicates what? Stable return. Moving forward, standard deviation. Standard deviation is a degree of variation of individual item of a given set of data from a average. So, how do you calculate the standard deviation? Square root of variation is your standard deviation. So, for capital budgeting decisions, standard deviation is used to calculate the risk associated with the estimated cash flow from the project. To understand how the risk is there which is associated with a particular project, the standard deviation is there. So, we have a different formula for variance as well as standard deviation, and when we take up the problem, we will discuss that. Moving forward, problem 3, calculate the variance and standard deviation on the following data given. So, how to standard deviation formula you got to know. Square root of variance is standard deviation. Variance is equal to your net cash flow minus expected net cash flow for the year 1 into probability. So, this is your for the first year. For the second year, data is given net cash flow minus expected net cash flow for the second year into probability. It goes on. So, this is the formula of variance and standard deviation. So, project A and project B is given. Possible events A, B, C, D, E is given. Cash flow we have for all the possible events and the probability assigned. Project B, cash flow is assigned and the probabilities are assigned. So, first step is what? To calculate the expected value for a project A. In order to calculate the variance, we want what? Expected net cash flow. What we want? Expected net cash flow. So, we have to calculate the expected net cash flow. How to calculate the expected net cash flow? Cash flow into probability. You will get your expected value. The summation of all the occurrence of event will be your expected net cash flow. Project B similarly will calculate the expected net cash flow, that is 16,000. So, how did you get 24,000 into your probabilities? If you do it, the summation of expected value will be your 16,000. Moving forward, we have got our expected net cash flows. Now, we need to calculate what? Your variance. Moving forward, we have to calculate the project A variance. What is the formula? Net cash flow minus expected net cash flow into your probability. So, this is whole square. So, 8,000 your net cash flow minus expected net cash flow is how much? It is 12,000 whole square into probability. In the same case for your occurrence 2. So that is your possible event B. So 10,000 is the net cash flow minus expected value, net present expected net cash flow. It is 12,000 whole square into probabilities. You have to do it and then you'll get the values as 16 lakh, 8 lakh, 0, 8 lakh plus 16 lakh. The variance you get is 48 lakhs. So you have got the variance. How to calculate the standard deviation? It is very easy. The square root of your variance is standard deviation 48 lakh. If you take up the square root, the answer you get is 2190. Similarly, you have to do it for the project B. So project B variance, what is the formula? Net cash flow minus expected net cash flow whole square into probability. So if you do it for all the occurrence possible events, the value you get is 1 crore 76 lakhs. So the under root of that, if you remove the root, you'll get 4,195. So moving forward, now let us know what is your coefficient of variation. So to measure the standard deviation, in few of the cases the difference will be very similar. So at that time it will be very difficult for the financial manager to take up the decision. To have a better clarity in the project, you have your coefficient of variation. So what is the formula of coefficient of variation? Standard deviation divided by expected cash flow. Standard deviation divided by expected cash flow, you get your answer. So let us take up the problem and discuss the coefficient of variation. Similarly, all the steps you have to follow. Probability you have to calculate. You have to calculate your expected net cash flow. With the help of expected net cash flow, you need to calculate the variance as well as standard deviation, because what is the formula given? Your standard deviation divided by expected net cash flow. So you need to calculate expected net cash flow as well as your standard deviation. If you want standard deviation, you need to calculate the variance. So all the steps as we have solved the problems, that is your third problem, second problem, it is similar. So A, possible events. Project A, probability as assigned. Project B, probability and your cash flows are assigned. You have to calculate your expected net cash flows for both the project, 14,000 and 18,000. So with the help of this, you need to calculate the variance. When you get the calculation of variance, standard deviation, you will get 2,190 and 4,195. So standard deviation is very similar now. So what you need to calculate? Coefficient of variation. So how do you calculate the coefficient of variation? Standard deviation divided by expected net cash flow. The answer you get is 0.1565 and for project B 0.2331. So the risk is very less here in case of project A, and project E risk is more. When risk is less, the value also will be less. When the risk is more, always the expected value also will be more. So they prefer project A since it is risk. You can say the risk is very less in case of project A. That's why the firm is seeking for project A. So in project A, as per rupee of cash flow, that is 0.10565, while in the project B it is 0.230. So project A is better than the project B. So that is what they like to say. So that's it for today. Hope the session was very interesting, fruitful. A smile is the biggest jewel you can wear. Keep smiling, people. Thank you.